Three quality stocks to buy near their 52-week low. This is a segment that I used to do every Saturday where I analyze you guys' requests and I look at stocks trading near their 52-week low, and I love doing it very much, so I'm going to do it again. And I have three amazing ideas for today, especially the second one. It's an amazing high-quality company. It's been flat since 2021, but it's really a good company. So I'm going to talk about it and talk about two others. So I really hope you enjoy it as always. The first one, and I'm going to keep it short, it's Adobe. Adobe is still down 25% over the last year. And I'm going to be honest, guys, I would not be surprised if Adobe has actually bottomed. It's really hard to call a bottom in the market, especially when the stock has been going down for too long. But based on what I'm seeing, where the stock is being positive for like 2 or 3 days during the sell-off that we had after reporting earnings, maybe the market is finally realizing that Adobe is too cheap to ignore, that AI is not killing Adobe, and it's not going to kill the Adobe business model anytime soon. But there's many indicators that are actually backing this up. One of them is revenue growth, where Adobe put up another quarterly revenue growth of more than 10%, and it's been growing 10% since December of 2022. Now, if AI was killing Adobe, Adobe would be clearly decelerating in revenue growth, but this hasn't happened. Although the estimate was like 7 or 8%, so they were estimating a deceleration, but that hasn't happened. So AI is not killing Adobe, not now and not anytime soon. Same thing within net profit margins, where if there was a lot of competition from Canva and AI and all these kind of apps and Figma and all of them, Adobe would have to do a lot of promotions. They would have to market themselves a lot and give a lot of discounts for them to win market share or maintain market share. So in this case, their net margins would compress, they would face a margin compression, but that hasn't happened. Their net margin is still over 30%. So I'm not seeing any indication that AI is killing Adobe. The report, in my opinion, was amazing. They mentioned AI 74 times in their report. So that would tell you a lot if they're ignoring AI, if they're sleeping on it, or if they're actually trying to benefit from it. And their total new AI-influenced ARR annual run rate has exceeded 1/3 of their overall business as they integrate AI in their solutions. 1/3 of the business has something to do with AI. In my opinion, this is absolutely amazing because it wasn't like that last year, and even 2 years ago, it was like 2 or 3%, I believe. In terms of monthly active users for Acrobat Plus, where they own the Adobe PDF, there's over 3 trillion PDFs all around the world, and it has surpassed 750 million users, growing 20% year on year. Absolutely amazing. They did acquire the SEMrush company, and there's going to be part of Adobe. SEMrush, I believe, is growing 30 or 32%. So it's going to bring in a lot of growth within the Adobe ecosystem, but it's not expected to impact earnings per share in the first year. So it's not going to impact before 2027, but I believe it was a good acquisition, and it looks like Adobe is looking to do many more of those acquisitions. Now, in terms of the multiple, in terms of how much we're paying for that, because I believe AI will ultimately affect Adobe in some way. I believe the growth will ultimately decelerate at some point. But as Howard Marks says, it's not just about what we're buying, but it's how much we're paying for what we're buying. Because if we're paying a fair price, then we could still make a lot of money, even if AI affects Adobe. Now, if we look at the Adobe multiple, it went from 50 times to 15 times earnings. So I believe a lot of the bad is priced in. This is on a non-GAAP basis. GAAP PE is around 19 times earnings, which I still don't believe is overvalued. I believe it's extremely undervalued for a company that has 97% recurring revenue business model, and it has 30% net income margin, and it's still growing earnings per share 13%, and it's expected to keep growing earnings per share 11 to 12%, and you're paying 15 times earnings for that. I don't believe this is expensive at all, so I still believe Adobe is presenting a good buying opportunity here, and don't quote me on this, but I would not be surprised if Adobe has actually bottomed and maybe it's headed much higher from here. The second one is MSCI. MSCI is an amazing example to what happens to you if you overpay for quality. MSCI is an amazing company. They have grown earnings per share a lot, free cash flow per share, all the metrics you want to look at. All of them are amazing with MSCI, but the stock has been pretty much flat since 2021. just because a lot of investors, they overpaid for quality. It was trading at 50 PE, now it's trading about 29 or 28 forward PE, and it faced a multiple contraction where the company is growing into its overvaluation, and I believe we are nearing the end of this consolidation, and there will likely be a massive breakout on MSCI. But this is why, again, valuations matter. Maybe they don't matter in the beginning, but they ultimately matter, and not every stock is the next Costco and it's going to trade at 50 times earnings and never go down. This is a really good lesson in my opinion. But MSCI is an amazing business. If you look at the total AUM, asset under management, they are benchmarked to an MSCI index. It's about 18.3 trillion dollars. Absolutely amazing. The company's revenues are recurring. 98% are recurring revenues, which I believe is amazing. 57% is the index. 23% is analytics, where they sell a lot of systems and analytics to a lot of those companies. And they have something within sustainability and climate and private assets and a few other businesses. But it's mostly an index business. And the index businesses are really, really amazing. You can see it from the metrics of MSCI. They grew revenue 13% CAGR over the last 5 years, adjusted EBITDA 14%, earnings per share 17%, free cash flow 14%. So everything has been amazing, but the stock has been flat. And to me, this is getting very, very interesting. The company has about 40% net income margin. This is as high as MasterCard, and they have 27% return on invested capital. Very efficient business, very high return on invested capital. But if we look at the multiple again, it was trading about 60, 61, 62 times forward earnings, and it got cut in half, and it's now trading at about 29 times forward earnings, well below the average of 35 times forward earnings. And by the way, I'm using Fiscal.AI to come up with all those charts. If you want to try it out, they give you 2 weeks of free access if you use my link down in the description. But I believe 29 times earnings is still expensive, but it's not extremely expensive for a company that has around 40% net income margin, is growing earnings per share decently well, and is expected to keep growing earnings per share 13% annually, and you get a 1% dividend. If the multiple doesn't expand or contract, I'm looking at a 13-14% annual return for an amazing company like MSCI. I don't believe this is bad at all. But if you want some margin of safety with MSCI, if you're worried that the multiple could contract further, and it could very well happen, I would personally not pay much more than 25 times earnings for MSCI. I think if it gets to 25 times earnings, it would really be providing a very nice cushion or margin of safety, or whatever you want to call it. And for us to get this number, we get the next year earnings per share estimate of 1936. We will put in 1936, and we time it by 25 times forward earnings. This is $484 per share. The current price is $551. It was trading there really not long ago. I mean, I believe late in 2024, even early this year, it got close to that. I would not be surprised if it gets there, but even if it doesn't get there and you're willing to take the chance of a multiple contraction, I think the MSCI setup here is very, very interesting. After the stock has been flat for over 4 years, it's an amazing company. The CEO was buying, he bought 2 times, I believe, in 2025. And I love MSCI. I think this is a very interesting one. The last one is a stock that I haven't talked about in a while, and it's been a little bit crazy. And this is Cheniere Energy. Cheniere Energy stock has been going down a lot. It's down 14% year to date. It's down those last 6 months about 20%. And Cheniere Energy has the largest liquefaction facility in the United States, over 11% of global liquefaction capacity. And they pretty much get the gas, they freeze it, they liquefy it, you could say, and they ship it all over the world. They ship it to Europe, they ship it to Asia, but most of it is to Europe. Then they ship to Asia a little bit, they ship to Latin America. They pretty much ship it all over the world. Now, the beautiful part about this business model is it's not really too correlated with natural gas prices, because most of it is fixed for the long term. So 95% of their contracts are through the mid-2030s. They sign 15, 20, sometimes 25-year contracts at mostly fixed prices. So this is more of an infrastructure kind of bet on Cheniere than just a bet on natural gas where the stock goes up and down 10% in a single day. It's a beautiful, beautiful business model, and I love it very much. And you can clearly see it from their latest quarterly guidance for 2026. This is 2026. They have $51 to $53 metric tons for natural gas. 47 of them are pretty much in long-term contracts, and they have like 1.5 to almost to 3.5 that they can sell on the spot market, and they could benefit from volatility in prices. But most of it is fixed for the next 15, 20 years. So the company has a lot of visibility, and it's just an amazing company, but it's been going down a lot recently. And this is due to one reason, which I talked about before, and I'm going to talk about it again since a lot of you asked me. And this is mainly because of an upcoming oversupply that could happen, and it's about to happen globally, but mainly in the United States. Before Donald Trump came in, Cheniere Energy had a moat. It had a competitive advantage because they had those liquefaction facilities in Corpus Christi, and they're very, very big, okay? And you can't really just go and build another facility. But the president made it very easy for you to get a permit and for you to build more of those export facilities. And there was a lot of exploration in general for natural gas in the United States. And there's a lot of those export facilities being built, just like Cheniere, and some of them are even larger. They are coming online over the next 1, 2, 3 years. So Cheniere no longer has the moat that it used to have at one point, where they had the infrastructure and you can't really go build another one. Now they're building them all over the place. So Cheniere will have more competition. Now this is a little bit overblown because they still have decades of relationships with many companies that buy from them, and they have 95% of their contracts to the mid-2030s. So they're not going to be too affected by it, but they could also face some margin compression and some more competition in general. But in terms of the global capacity for LNG, it's set to increase by a staggering 60% by the end of the decade. Demand growth is unlikely to match the pace, while supply and demand is largely imbalanced this year. The market is expected to tip into an oversupply of nearly 50 BCM in 2026 and as much as 200 BCM in 2030. So the market is going to enter an oversupply, and this is mostly from the United States. You could look at the yellow kind of bars, and it's the small ones that it expands further and further and further and further. And there were a lot of permits that were given to pretty much everyone to go build those LNG export facilities, and a lot of supply is coming online. And when a lot of supply comes online, eventually natural gas prices would go down, and there's more competition because LNG collects a liquefaction fee. So if there's more companies that can liquefy it for cheaper, some of the buyers might go with someone else. So that's a big concern, and that's why the stock has been going down. But I still believe, the company is well positioned because they have those long-term contracts, but they also have a relationship with their suppliers or their buyers that they've been pretty much buying from Cheniere for many decades, and they know Cheniere is reliable. So they're highly unlikely to switch to someone else just because they're a little bit cheaper and they don't have as good of a reputation, maybe like Venture Global or a lot of those other companies. But in terms of Cheniere, it's getting very cheap over here. The company is targeting $25 of DCF per share by 2030. DCF is a distributable cash flow per share. It's almost like a free cash flow per share metric. And the company has done a lot of things where they did buybacks, increase the dividend, and they plan to do even more of that. But they will easily reach 25, in my opinion. The management is very good, and they have a track record of over-delivering. The current multiple is 13 times cash flow. 13 times cash flow for such a predictable business model for 10 to 15-year contracts, in my opinion, this is cheap. It's really, really cheap. And I never thought Cheniere would go back to 13 times cash flow. But for my assessment, I'm going to take in 15 times cash flow, as I think it's a little bit more fair for Cheniere Energy. So I'm going to take in the 25 in DCF, and this is excluding dividends or anything you're going to get from the company. And I'm going to time it by 15 times cash flow for 2030. This is about $375 per share. The stock right now is trading at $189. This is almost 98% on the upside over the next 5 years with a company like Cheniere Energy. But I personally would not be surprised if they go back to 20 times cash flow. I think 20 times cash flow was not too extreme. I think 26, 27 was too extreme, but 20 times for such a resilient, predictable business model. I mean, almost like a software company, but with 10, 15-year contracts and fixed prices, so they're not too affected by fluctuations in natural gas. I think 20 times is really not egregious. Now, if Cheniere does get to 20 times, and we get 25 and we time it by 20, this is about $500 per share. and currently the stock is at 198. This is more than 152% on the upside over the next 5 years with Cheniere Energy. So I think the sell-off is warranted because, of course, oversupply is going to come in and Cheniere will have more competition. They don't have the physical modes that they once had, but I still believe they have the relationship with their suppliers, which is not going anywhere anytime soon. And they have those 15, 20-year contracts locked in, and that's not going to change anytime soon. So they have a lot of visibility, and the company will likely achieve more than a 25 DCF because they can buy back more stock at a lower price and increase DCF per share to maybe 30, 32, which they have done many times before. So I still believe in the company. I still believe the stock is undervalued, and I think the sell-off was a massive overreaction. And that was my opinion on Cheniere, on MSCI, and also on Adobe. It was not financial advice, so I hope you enjoyed it. If you did enjoy it, please press the like button and maybe consider subscribing. So I'll talk to you in another video.